Hi, this is Lara at Elliott Wave Gold with an extra video update for you for US oil after the markets closed, or the New York sessions closed, for Monday 30th of January. Short term, it looks like we might see a short sharp upward movement. A target would be about 55.60 if we see a new high above 55.24. Alternately, if we see a new low below 50.91, that would indicate a downward breakout, and the target would be 28.61 minimum, possibly as low as 25.59. I expect the upside is much more limited than the downside. Oil's consolidating. If it breaks out upward, my Elliott wave analysis expects the breakout should be short-lived. Let's have a look at the monthly Elliott wave count classic technical analysis last. From this high here for oil, I'm seeing a big zigzag unfolding down, subdividing 5, 3 and an incomplete 5, and cycle C is more complicated so far than cycle A. It has to be a 5-wave structure. So far we've got 1, a zigzag for 2, a complete impulse for 3, and it looks like a flat correction unfolding for 4. Flat corrections are usually more time consuming than zigzags, and so at its end primary wave 4 may be more time consuming than primary 2, and it might overshoot the upper edge of this trend channel, but in the first instance, when price gets up there again, I'll expect resistance. Fourth waves aren't always contained within their channels, which is why Elliott developed a second technique to redraw the channel when the fourth wave overshoots it. If it isn't finding resistance at the upper edge of this maroon channel, then I'll expect price to find good resistance at the upper end of this teal channel. This channel is drawn using Elliott's technique for a correction from the start of A to the end of B with a parallel copy on the end of A, but it's not perfectly showing where upward movement is finding resistance. It's been broken through, found support, and then broken through again. If primary 4 gets up that high, and I don't think it will, but if it does, then it should find resistance there. Primary 4 may not move into primary 1 price territory above 74.96. So far within primary 4, this upward movement fits best as a double zigzag. If my analysis of A as a double zigzag is correct, then primary 4 is unfolding as a flat correction, and we can't relabel it as a combination. If this is a double zigzag, I can't relabel this intermediate wave W, because you cannot label multiples within multiples. The maximum number of corrective structures within a multiple correction for Elliott wave, the rule states, is 3. So to label W, Y and Z themselves, W, X, Y, X, Z, increases the maximum beyond 3 and violates the rule. The rules of Elliott wave are black and white, with one sole exception. And so primary 4, if A subdivides as a 3, is unfolding as a flat correction. Flats subdivide 3, 3, 5. Within the flat correction, intermediate wave B also looks like it's unfolding as a flat correction and expanded flat. Let's have a look at this at the weekly chart level, where this high for intermediate A is this point up here, and here's the double zigzag, 535X, 535Y. I've tried to see if this upward movement will fit nicely as an impulse, and it can be made to fit, but it just doesn't have as good a fit as seeing it as a double zigzag, and so my conclusion is it's most likely a double zigzag, but again I could be wrong. If intermediate A is a double zigzag, then intermediate wave B of a flat correction for primary 4 must retrace a minimum 90% the length of intermediate A at 28.61. If minor B is complete, then the target for minor C is 2.618 times the length of A at 25.59, because that would see intermediate wave B end within the normal range for a B wave within a flat, from 1 to 1.38 the length of the A wave. So at 26.06, intermediate wave B would be 1 times the length of intermediate wave A, and at 16.33 it would be 1.38 times the length of intermediate wave A. Within intermediate wave B, it looks like it's unfolding as an expanded flat correction. They subdivide 3, 3, 5. So when minor B is complete, we'll need minor C down. This is my first wave count. Let's look at this at the daily chart level, where the end of minor wave A, which subdivides as a single zigzag quite neatly, is this low down here. And my first Elliott wave count, which is the same one I've been using up to now as a sole Elliott wave count, sees minor wave B up as a single zigzag, subdividing 5, 3, 5. Within it, minute wave B is seen as an expanded flat. Minute wave C here is seen as a complete 5-wave structure. Minor wave B here is a 1.29 length of minor wave A, so remember that normal range for a B wave within a flat is from 1 to 1.38, so if it's over here it's within that normal range between 1 to 1.38 times the length of minor wave A. If this is correct and minor B is over here, then minor wave C down should have begun. So far we might have minute wave 1 and minute wave 2 may be an incomplete expanded flat. There's a lot of expanded flats in this wave count. Subdividing 3, 3, 5. Minuet wave C needs to be a 5-wave structure. There are only 2 structural possibilities for C waves within flat corrections, either impulses or ending diagonals, and the most common type of diagonal is a contracting diagonal. So we may have a zigzag for 1 and 2 and 3 and 4, and then we may have a short little zigzag up for 5. Minuet C would be extremely likely to move beyond the end of A, above 5, 4.50 to avoid a truncation and a very rare running flat, but it can't move beyond the start of minute 1 because minute 2 can't move beyond that start above 5, 5.24. As soon as we see a little overshoot of the 1-3 trend line, then this possible contracting diagonal could be complete. If that happens, look out for a quick reversal and an increase in downward momentum, in other words a downward breakout, as a third wave down unfolds, and we can have some confidence in this wave count if price moves below 50.91. If we see a new high above 5.24, then that first idea is invalidated, and then we can have some confidence in the second idea. And here's the material difference. It's all identical up to this point here, and now I'm seeing minor wave B not as a single zigzag but as a double zigzag. The material difference is seeing this upward wave as a zigzag and not a 5-wave impulse. And this is the core problem of Elliott wave. It's impossible very often to tell if a movement is a 5-wave impulse or a 3-wave zigzag, and if you can't tell if it's a 3 or a 5, then you have to consider both possibilities. It's easy to tell triangles and flats apart, but it's not so easy to tell impulses and zigzags apart. If this is a zigzag, then it does have a better look than the first wave count, which tries to see this as a 5-wave structure. So we could have the first zigzag in the double, labelled minute W. The double is joined by a 3 in the opposite direction, labelled X, and here we may have a 5, 3, 5. I need to fix my label for the first wave. It needs to start down here. Now the problem here becomes within minute wave Y, this first wave looks like a 3-wave zigzag and not a 5-wave impulse. And again, back to that core problem. The problem arises when the corrections within an impulse 2 and 4 are disproportionate. It's possible in here that the corrections of 1, 2, 3, 4, 5, there's probably a third and fourth wave up in here, are disproportionate. When the fourth wave is much briefer, or vice versa, then its counterpart second wave, at a higher time frame, it turns what could be a 5-wave impulse into what looks like a 3-wave zigzag at a higher time frame. And that's, depending on the market, that's often a real problem. For commodities especially, they tend to exhibit swift, strong fifth waves, ending in blow-off tops or selling climaxes. When they do that, those strong fifth waves force the fourth wave that comes just before them to be relatively brief and shallow, and it gives the whole thing at a higher time frame a 3-wave look to it. That certainly could have been what happened here. It usually happens at the end of a movement though, not at the end of a first wave. It's usually at the end of a third wave and the end of a fifth wave, and so this would be unusual. So that does slightly reduce the probability of this wave count, but we have resolved a problem within this piece of movement, increasing the probability, so back to about even. The second zigzag will be incomplete, subdividing 5, triangle for the 3, we need a 5 up. Minuet C would be very likely to move beyond the end of A to avoid a truncation. It hasn't done that yet. The extreme of this running triangle for minuet wave B is not part of minuet C. Minuet C itself has still not moved beyond the end of A. The target 55.60 expects that minor wave B will end within that normal range of minor wave A from 1 to 1.38, and so that's why I've used this Fibonacci ratio to calculate the target. It gives us a target which sees the whole thing 1 degree higher ending within, or 2 degrees higher ending within its normal range. This wave count would expect a short, sharp upwards thrust and then a reversal, and we still need to see minor wave C down. Intermediate wave B, for the bigger picture, still needs to reach that minimum for a flat correction at 28.61. It still would be likely to end somewhere within this normal range in relation to intermediate wave A, which you can see on the weekly chart. Now, I know this is all really confusing, but the problem here is oil is within a B wave of a bigger correction, so there are multiple structural possibilities for B waves. It's important to consider all possibilities. Let's have a look at some classic analysis and see which of those two wave counts has more support, if either of them do. Oil is essentially range bound. It's got resistance here about 54, just slightly above, and support here about 52 and a little bit lower, just above 50, between 50 and 50.5. So it's moving from support to resistance and back again, and in conjunction with stochastics, if we use a range-bound approach, we can see when each swing ends and the next one begins. It's not perfect though. Resistance and support can be overshot, which means timing your entry can be very difficult, and price doesn't move in a straight line from resistance to support and back again. When a market's consolidating, it tends to be very choppy and overlapping. For those reasons, trading a range-bound market is best left to very experienced professionals only. Anyone who's a novice or intermediate degree trader really should be avoiding a range-bound market and waiting for a breakout and then joining the next trend. That would be the safest approach. During this range-bound period, we can look to see which day's volume has strongest volume, up or downward days, and it's this upward day here which has strongest volume, indicating that an upward breakout may be more likely than downward. Now that trick doesn't work, it just all the time, it just tells us that on balance of probability, we are more likely to see an upward breakout from this trading range than we are to see a downward breakout. As price is essentially moving sideways, volume is overall declining. That's very typical of a consolidation. ADX is flat and it's below 15. That tells us the market is not trending, it's consolidating. ATR is now declining. That's also very typical of a consolidation. The breakout will come soon. We need to see a breakout above this point and below this point, preferably on a day with an increase in volume, to have any confidence that we are seeing a breakout. On balance, volume is also constrained. It's come down today to touch this support line. It's been tested 3 times prior. It's reasonably long held. It has a reasonable slope, so it has some reasonable technical significance. This line may assist to halt the fall in price here and assist to push price up from about here, along with this support line for price. And so that would favour the alternate Elliott wave count, which expects some upward movement from here. This volume day here also favours the alternate Elliott wave count over the main Elliott wave count. RSI is pretty close to neutral. There's plenty of room for price to rise or fall. Stochastics is returning from oversold, not quite there at overbought yet. Price is returning from support. It did reach resistance though, so I would really be expecting that stochastics may not reach resistance, and if we're expecting that the market remains range bound, then it would be reasonable to expect stochastics to turn around and move back toward oversold, and price to turn around and move back towards support about here. Now that's the last problem with trying to trade a range-bound market. That last swing in the market that you expect using resistance and support and stochastics to aid when price is going to turn, the last swing never comes, and that's finally when price breaks out. So if the alternate Elliott wave count is right, we'd be now looking for an upward breakout. So I'd want to see a green daily candlestick closing well above this line, just above 54, preferably on a day with an increase in volume beyond the last several days, and that would be a classic upward breakout, and then I'd have quite a lot of confidence in that alternate Elliott wave count, which looks to be slightly more likely at the beginning of this week than the main wave count. That's all from me with your oil analysis this week, and I'll be doing an extra update toward the end of the week for members only. If any other viewers would like daily analysis of gold and weekly analysis of oil and silver, you'll find it in the membership area of Elliott Wave Gold.